is Rosalind Lewis coming to you from JP and Associates Realtors, Carolina Living. And today I want to talk about credit scores. This is the first video of a series I'm doing about credit. But today's video is about your credit score, how your credit score affects your ability to buy a home. If you are thinking about buying a home and your score is a little low, or it's a perfect credit score and you have been asking yourself what that looks like or how does that affect my ability to get a loan, then this video is for you. So let's get started. If you have watched some of my other videos, then you know that I always tell my buyer clients that the first step to buying a home is getting a pre-approval letter. That means having a conversation with a lender. That lender will have to pull your credit, and they do what we call a 3 credit bureau pull. And out of the 3 scores, they will use your middle score. But basically, you want the lender to pull the credit so they can help you decide which program is the best fit for you. The minimum credit score you need is totally dependent upon what type of loan product you're using. Sometimes people watch my other videos and they feel like the down payment assisted programs is the starting point. But first, you must be approved for one of the basic loan programs. And I say that there are 5 basic loan programs: FHA, VA, conventional, USDA, and then there's the FHA 203K program for those who find a home and fall in love with a home that needs a little bit of love. Now, all of those programs have their own minimum requirements for whatever reason. Some of them are government-backed loans, and some of them can be a bit more flexible because the borrower is putting more money down. First is the FHA loan program, and your credit score needs to be at least 580. Now, there are some lenders who will go down to as low as 500 credit score, believe it or not. But if you happen to be below 580, your interest rate will be much, much higher. So you really want to have at least a 580 credit score to get a better rate, or what I call a livable rate. The Federal Housing Administration, or as we call it, FHA, does not actually provide the loan. They just insure the loan in case the borrower defaults, and this loan is typically geared towards first-time home buyers, which is great. If you're looking to get a VA loan, you must have at least a 620 credit score. Of course, this program is for our awesome veterans, and they totally deserve it. So for this program, you must have at least a 620. Some lenders will go down to as low as 580. And again, if you are below that 620, they are going to give you a much higher interest rate. The third loan product that I want to talk about is the USDA loan. Now, the USDA loan is geared towards properties that are in rural areas outside the city limits. However, there are some income requirements. There is a debt-to-income ratio requirement. There's also a number of dependents requirement. And all that depends on how much money they will loan you for the house, or how large your loan can be. But you must have at least a 640 credit score because this is a 100% financing program. The fourth loan program I want to talk about is the conventional loan. You must have at least a 620 credit score for a conventional loan. A lot of people feel, or they believe, that you must have at least 20% down in order to get a conventional loan, but that's not true. You can have as little as 3% down, and again, that is completely dependent upon your credit. So last but not least, we have the FHA 203K loan. This loan has a lot of stricter requirements for the FHA. So if you walk into a house and you love the location, you love everything about it, but there's just some type of damage to the property, carpet needs to be replaced, or it needs to be painted, or it needs a new kitchen, then if you have a 620 credit score, then you can take advantage of the FHA 203K program. So if you want to buy a house and you know your credit is not amazing, is there anything that a lender can do to help you buy this house, or to help you buy now? And the answer is yes. These are called compensating factors. And these are things that the lender will take into consideration during a manual underwriting process. So the first compensating factor that they will be considering is if you will be putting down more than 10%. What this creates is called a low loan to value ratio. That means you have some skin in the game, and I want to put down the minimum. However, you are putting down enough money where the bank feels confident that you will pay back the loan. This just gives the bank confidence in you as a borrower. The next compensating factor is, do you have a large amount of money in savings? Some people have saved a whole bunch of money, but they have a really iffy credit score. Banks like to see that you are not living beyond your means, that you have excess reserves saved. So that's something to think about. As if you do not have a 580 credit score or even a 560 credit score, or you have a 600 credit score, the bank will take in consideration the amount of money that you have saved in the bank. Now, this is not how much money you can gather from friends and family. With loans, this is the money you have saved over a period of time. Another compensating factor is if you have a high income. As you know, a lot of students graduate from college with a lot of debt, student loan debt, credit card debt. But if you have a high income and high debt, those are likely the two things they will take in consideration. Another compensating factor is if you have a low debt to income ratio, or DTI. This is one of the things that the lender will look at. You can't have a great credit score of like 750 or 800, excuse me, and be maxed out with a lot of debt and then try to get a house on top of that. So if you have a nice car and take vacations on credit cards and things like that, and your debt to income is really bad, you need to work on getting that debt to income ratio down by paying down some of that debt. And then there will be a positive compensating factor. Therefore, your credit score. But of course, paying down your debt will increase your credit score. So you basically will be taking care of both problems at the same time. The other compensating factor that a lot of borrowers do not know about and don't think that the banks will consider is if you've been at a job for a long time. If you have a long employment history and in the same field and with the same employer, then they will look at that as a huge plus. So if you have been in the same job for many years in the same career, that's a very good compensating factor. Yay for long employment history. So it's all about credit today. So what is the definition of good credit? In my chart above, you will see that your very bad credit is 300 to 560. Bad credit is from 560 to 650. So if you have bad credit, and again, it is anything 560 to 579, and below poor credit is 580 to 619, you can get a house with poor credit by this definition. However, you see the cutoff is 620. They do not give you a lot of down payment assistance programs until you get to 620, which is fair credit. So fair credit is a score between 620 and 679. So you don't even get into the average credit ranking until you are at 680. And then from 620 to 700, you're considered fair. That is average. That is an average score of what people have. But you really want to be at a great score. A great credit score is anything 750 and higher, and a great credit score means that you can basically walk into a bank and all those low advertised loan interest rates that you see, you will get the pick of the best rate, the best loan product, and the best terms they can offer. Because they don't need to look at compensating factors and things like that. They can see that you have good credit. Of course, they will look at your assets, your DTI, and things like that. But your credit will set you up to get the best of the best from the bank. So if you have a credit score that is 579 or lower, that means that your interest rate will pretty much automatically be 2% higher than the lowest offered interest rate from any bank. This does is increase your monthly mortgage amount, and it automatically takes you out of the running for any down payment assistance. You will have to put more money down, so 2% more on your interest means your principal and interest will be higher, and your taxes and insurance will fluctuate with normal activity like tax increases or insurance spikes or something like that. If you have a 580 to a 619 on average, you can expect to pay 1% more than the lowest advertised interest rate of a bank. If you have a credit score of 620 to 679, it's not a big deal, but you can expect to pay 0.5 or 0.5% more than the lowest advertised interest rate from any bank. But again, if you have that 740 or higher, which is what everybody wants, then you can buy a house. You will get the best interest rate that a bank can offer. If this video has been helpful to you, please let me know in the comment section below. Also, I want to invite you to subscribe to my channel and make sure to click the notification bell below so that you will know when I upload a new video. And I usually post a new video once a week. All my contact information will be in the description, and I look forward to hearing from you. Have a great day.